Happy day, YouTube family. This is Stocks with Josh, and we're asking ourselves today, is the markets going down from here? Well, yesterday we knew that the White House and Wall Street were expecting the CPI numbers to come in hot, and that's exactly what they did. Inflation hit its highest level in over 40 years, coming in at 9.1% versus the estimate of 8.8%. Yet the markets were largely unresponsive and closed the day flat. The VIX, which measures volatility, it spiked up initially, but then basically it calmed down. The White House pointed out that these figures were out of date and that oil has come down off of its highs, that energy makes up nearly half of the monthly increases in inflation, and they claimed that the CPI data does not reflect nearly 30 days of decreases in gas prices. This has basically reduced the price of gas at the pump by 40 cents since mid-June. However, technically on oil, we're still above the 200-day moving average. This is an indication that it's still technically bullish and could easily spike right back up, which would simply lead us back to rising inflation, which of course would continue to put pressure on the Fed to continue to raise rates aggressively. In addition, oil is currently giving an oversold indicator. This could easily make more room for a bounce from here. The Fed funds rate futures as of yesterday, which is basically the speculation as to what the Fed funds rate increase will be, as of yesterday, it was beginning to move up in pricing to 100 basis points, an increase basically rather than the 75 basis points. At the moment, 59% expect a 75 basis point and 41% expect a 100 basis point. If that continues to rise, then the markets will price in the higher basis point and then they're going to begin to fall. Both of these increases are significant and will basically affect the market in different ways. As always, what the market, will be most affected by is the unexpected. If the market prices in 100 basis point and the Fed for some reason goes up to 125%, then the markets would think inflation is out of control and the markets would flush. If the Fed were to come in at 75 basis points when the market's pricing in 100, then the markets will basically fall because they believe the Fed's not dealing with inflation. It's ultimately going to continue to damage the economy, leading to a longer recession, which would need to be priced in. So what's going to move the markets in the week ahead? It's basically going to be earnings. Next week, we have JP Chase and Morgan Stanley's earnings. And if they're bad, then the markets will not go bullish in the short term. So let's talk about the S&P right now. We're still trading below a 5-day range, which is still bearish. The trend continues to the downside. So I'm going to basically continue to have a bearish bias. We discussed leverage 3x SQQQ, which shorts the NASDAQ. If we get a confirmed break to the downside, then I'm going to be initiating a position. I'm also looking at gold, which is entered into an oversold area, and I'm looking at starting a position. So, you have to be aware that we have not established a bottom there yet, but I'm basically watching it for a point of entry. One of the other factors which will drive my decision making will be looking at the dollar, which, if it begins to fall back, that would be very bullish for gold moving forward and would definitely be a confirmation to me to buy. Of course, also stocks would rise if the dollar fell. I'll basically be talking about my gold plays coming up separately in an upcoming video. I'm going to take a station break, and after that, we're going to discuss what will likely drive the markets lower. Don't forget to hit that like if you're enjoying these videos, and remember that anything I say is for educational purposes and is not a suggestion for you to buy and sell. As always, there are people impersonating me in the comment section using my face, my picture, my name, and trying to get you to reach out to them on WhatsApp, Instagram, and Telegram. It's not me. Those are scammers, so be safe. All right, I also want to touch on Verb. It's continued to show signs of strength as it consolidates in the 50-cent range. The longer it consolidates in the 50-cent range, the more bullish that's going to be. If you're unaware, we're doing a small account challenge using Verb stock where we're going to basically turn $200 into $400. And if you guys would like to join along, there's a link in the description of the video to download moomoo. I specifically use moomoo because they offer the retail trader working on the ability to trade on their phone. You can have access to full 16 hours of extended trading. They provide basically the best mobile charting, which integrates with your desktop version. So whatever you do there, you can also see on your phone and vice versa. So moomoo right now is offering 5 free stocks if you deposit $100, which you basically randomly draw, and you can get up to $2,500 a stock each one, drawing 5 times. We're using moomoo to focus on riskier swing trades right now. We're doing Verb. We're going to continue to trade it as long as the trade setups remain bullish, but I am going to introduce other stocks or even leverage 3x, triple your money ETFs in the course of time. That's why I begin to slowly talk to you guys about them and introduce them, because I'm believing we might do that to introduce you guys to those types of ETFs. At times the challenge is going to move slowly, and other times it's going to move very quickly. Okay, I want to cover 3 things that could crash this market that I want you guys to be aware of. Number 1 reason why the markets could drop would be the rise back in oil. I've tried to make that to be the focal point because that is the truth. Remember, if oil goes up, energy goes up, which makes transportation services rise, and that ultimately drives up the cost of food. And it's extremely important to note that the Fed's increase on the interest rate has no direct impact on the rise or fall of oil prices. The one who has the biggest impact on oil within the U.S. is the president. He sets policy that will basically increase or decrease the supply of oil. And remember, inversely, if oil continues to drop, transportation services are going to drop, which will ultimately lower food prices, which is going to be in inverse very bullish for the market. So we must keep an eye on oil. That's the number 1 right now. Number 2 reason the markets could drop would be bad earnings. Reports are coming out heavily between July 18th through July 29th. Earnings will basically point to how deep of a recession potentially will be ahead of us. At the end of the day, GDP and earnings tell the true health of the economy, okay? I always like to remind people that it is innovation and technology that has the power to drive markets to new heights. Okay, and finally, I want to cover the number 3 reason the Fed's interest rate that the markets could drop, which would be the Fed's interest rate hike, okay, the 27th of the month, and the GDP numbers on the 28th, which again, as stated earlier, the markets could flush if the Fed does the unexpected. Just him making the interest rates rise would not crash the markets. It's him doing the unexpected. So in conclusion, the markets are in tension of basically trying to balance right now. The direction, is being fought out daily by the bulls and the bears. The majority of the bad news, in my opinion, is currently been priced in. What the markets will be taking into consideration in the coming days are these 3 things. Oil, if it reverses its downward trend, earnings, the true indicator of corporate health, and the Fed doing the unexpected. And currently, as I said before, 100 basis points is slowly what the market may be pricing in until then. There's plenty of opportunity daily in the markets, which I'll continue to bring to you guys' attention. As always, I appreciate you guys letting me be part of your financial journey, and I hope you guys all have a great day. Thanks. Bye-bye.